I'm Samantha Rowan, and this is ReFi Radio. I'm here today with Nevin Sanli, Managing Director and Founder of Astrum Investment Management, for our first Emerging Commercial Real Estate Manager podcast. Thank you for being here today, Nevin.
Well, thank you. Thanks for inviting me. I appreciate it.
Of course. Astrum recently launched Astrum Fund 1, which is your first commercial real estate fund. The plan is to raise about $110 million in debt and equity for U.S. sale-leaseback buyback opportunities. I've written a lot about sale-leasebacks over the years and wondered if you could explain the distinction between a sale-leaseback and a sale-leaseback buyback.
Sure. The sale-leaseback buyback product we have, and we call it SLB3 because there are three B's in it. And this product's unique feature is the buyback feature. It is an option to buy back the property to the original seller. The idea here is that we buy the property, lease it back for 20 years to the existing owner-user, and in year 5, they exercise their option. Our wish is that they exercise their option to buy us back at a predetermined price. That predetermined price depends on our purchase price, on the lease payments, and the returns we promise to our investors, the internal rate of returns we promise to our investors as to what we want to achieve. So by using these three parameters to solve for the rate of return we want to deliver to investors, we can set these parameters. And why do businesses want to do this? Why do the business owners, which are middle market companies that operate in these properties, want to do this? Not because they want to sell the property. In fact, none of these properties are for sale. They need capital to grow their business. And in those situations, through this mechanism, we're able to provide them the capital to grow their business, for us to take title, get a lease going, so deliver returns to our investors, dividends, quarterly dividends, and then some capital gains on the tail end, and have the business own back their property like they always wish they did. So it is a financing mechanism for middle market companies that need growth capital, and we're using the real estate that they're not able to monetize right now, either because they're underwater or because they can't find anyone to loan on it. Our dialogue focuses on the cash need of the business, not value, which is a very difficult question to answer these days.
Absolutely, and it seems like that's also a very interesting strategy, like you were saying, for middle market companies who might need capital to grow or for other purposes.
Exactly. Now, it's not survival capital, it's growth capital. We will not loan to a business that just needs a lifeline for a year to stay in business for another year. We will only do these deals with companies that we believe are going to use the capital for growth, and we believe that they are at a critical junction in their pattern of growth.
What was your path to the launch of the fund?
Just a little bit of background. I own another company that I've owned for over 20 years, and that company is called Sanli, Pastorian Hill. And Sanli, Pastorian Hill is a business valuation firm to middle market companies. And that's what provides the proprietary deal flow for the fund, Astrum Fund 1. So when I wanted to get back into the real estate market in about 2009, after having bought and sold a few properties over the years, I realized that the markets were very risky, and I was looking for an alternative strategy. And I realized that I had this captive customer base of middle market companies, some of which own their own properties, but that need capital and can't borrow, and some of them legitimately need growth capital to effectuate a visionary growth plan. And I developed then this product that I believe serves their need, takes the dialogue away from value, and focuses on the growth of the business, and yet enables me to procure very nice returns to my investors with steady cash flows from a sticky tenant. The tenant never wanted to sell. These properties are not on the market. They don't want to sell because they don't want to move, and they don't want their employees to know that the building is for sale, because if they do, they will all start looking for jobs. They'll be worried. So the companies now find this to be a very attractive strategy because it doesn't change their lives a bit. Everything is the same for them. So this strategy was developed to fill the niche of financing needed by businesses and at the same time get back into the real estate market. With this strategy, we have a proprietary deal flow of companies that own real estate that we've already underwritten. We've already underwritten the businesses, their values. We have all of the diligence materials in file, and we know the real estate. We've visited it because they're part of what the company owns. So we do have a strategic competitive advantage in accessing a deal flow that is proprietary, but we're able to close a deal in a very timely manner because most of the diligence is done already, needs to be updated. But we know the company owners, we know their shareholders, we know the CFO, we also know their accounting firms, their attorneys, and their banks often. This proprietary deal flow enables us to, for the last 20 plus years, I've valued over 2,000 companies. I've determined that about 60 of them are candidates for our fund, could work for our fund. But our fund is a $110 million fund, so we're only going to be able to do 10 to 12 deals in the $8 to $12 million range each. So I hope to have 4 candidates per transaction. And I'm going to underwrite the A-plus companies and the properties there. And oftentimes we're able to buy them at below fair market value, even current values, whatever they are, but at a low values, because the companies are interested in the amount of capital they can clear out of the transaction for their business. So we are looking at below fair market value transactions at very good prices, and as a result, because we determined the rent based on the purchase price, their rent payments are low. And in year 5, they're buying us at probably below fair market value then, or at about fair market value today, so that because I need to make my capital gains targets in order to meet my total returns.
There's a lot of competition for core properties, and it seems like the proprietary deal flow that you see from your other company kind of will help you eliminate that step of the process and just make it a lot easier to source acquisitions.
Yes. It is a lot easier for us to source acquisitions from all of these people, but also from the accounting firms that are the current accounting firms of these companies. They're going to see this deal, they're going to work on it, and they're going to say, hey, we have a few other clients that would want to do this deal. No brokers involved. Yeah. So the potential for expanding the ultimate candidates is very high at all off-the-market transactions. We will not do a deal for a company that's listed their property. We're absolutely not interested because the mindset is already gone. That's not the mindset we want.
Yeah, and also then there's no brokers involved, and it might be a cleaner, like an easier transaction to complete.
Exactly. No brokers involved. No property management company needed. Only asset management. See, the companies are going to continue managing the property like before. All they're going to do is send us a rent check. Super triple net rents like before. And in fact, the companies, since they don't want to tell their employees, they're not going to tell their repair people to change anything. And on top of it, they'll want to expand into the property often. And we'll tell them, of course, go ahead, build additional space. That enhances my collateral. That enhances my property. And yet, why would they do it? Because they know they're going to buy it back.
Right. And also, when you're looking at properties, I think that you had said that you guys mostly look to buy core and value-added properties. Why those properties in particular?
Well, the type of properties these companies own are typically what I call office and attached pick, pack, and ship, warehouse, light assembly, research, design facilities. They're typically critical for the operations of the business. They're usually headquarters of these companies. So these are all middle market companies, typically $25 million and up to $200 million in revenues. And so these companies' facilities are critical to their operations. They're solid properties, typically in what I call light suburban industrial parks. And they're all located within an hour or two from LA by drive time, or at most 1 hour flight time from LA. The value add type, the value add comes from this is that the companies, for example, through their expansion may decide to get another warehouse, expansion facility. So they may say, hey, look, why don't we do the same deal over there? You buy it, we'll lease it from you, and we buy it back from you in 5 years. or they may want us to build it for them. So that becomes the value add aspect of the situation. So we with them, we build a suit to property and we lease it back to them, and then they buy it back from us in 5 years. As long as we achieve the numbers we want for our investors in terms of current cash flow to meet preferred dividends and the ultimate internal rate of return, so the capital gains at the sale time in year 5 of the transaction, we're happy as long as we can do the deals that way. So the value add comes from there. The other portion where there is a kicker in year 5 is that they buy us out at a predetermined price or 80% of fair market value, whichever is higher. So that if through unusual or unexpected changes in the worldwide economy, the real estate values go through the roof, well, they can make an overnight 20% profit, and there are no brokers involved, so it's net to them, except for taxes, of course, but they could double escrow it and create additional working capital for their businesses at the time they buy back their property.
Right.
And that works for us too, but it would have to increase significantly in value for that to occur, but we leave that opportunity available for them and for us to gain even more on the upside on the back end. But it's all, we have a floor price, though, that a predetermined contract price for the option to buy us back.
And also, are you focused mostly on the West Coast at this point, or do you invest nationally?
Just West Coast. Right now, it's maximum 1 hour flight time from Los Angeles. It's not to say that if we have a company here in LA that, let's say, has 3 warehouses, and one of them is, let's say, in Texas, and they want to include all 3 of them in the deal, that we wouldn't do that deal. But the deal typically has to originate here in Los Angeles.
Yeah, so you could actually go and do physical due diligence on the properties and see what's being offered without too much trouble.
Yeah, but the goal is to not have that extra diligence cost of flying, across the country and time zone changes and legal environment changes, etc. However, if it is a client for which we're going to do the deal here in California and they have a facility somewhere else, we'll consider that.
Is this a niche that you think is being kind of ignored or passed over by some of the larger players?
Well, I think that the type of properties we're dealing with are too small for the larger players. Also, the proprietary deal flow aspect is not available. Typically, what's for sale on the market, or they have a few relationships so that they grab them before they go on the market. Ours is the word sale is not even being considered. Our deals are focusing on situations where there's not even a thought about selling. That's the ones we like.
Yeah. It's almost like like we were saying before, it's like an alternate financing mechanism for them rather than a sale. It's almost like a loan in a way. Yeah.
Exactly. It's a form of a loan, and it provides substantial better freedom for the business to use the money and to do what they need with the money, and it provides us better security because, in fact, we don't have, if things go really bad, we don't have to foreclose. We just have to evict, which is a lot less expensive and time-consuming.
Yes, so I've been told by many real estate executives over the years.
Yeah, it's very hard to foreclose a company, but it's a lot easier to evict.
Now, shifting gears a little bit, initial marketing efforts for the fund were mainly targeted toward investors in Europe and Turkey. Why this group of investors?
Well, here is what happened. When I started, I thought that the people that would be most interested in investing in the U.S. would be overseas. And the reason I thought that is that the dollar is weak. I thought that also U.S. investors have enough of U.S. real estate. They don't need more. And I figured that I should focus my interest where I have the highest likelihood of success. And I grew up in Belgium. I did my K through 12 in Belgium. And I was born in Turkey, and my parents are Turkish. So I do have the relationships, the childhood friendships that have developed into sometimes business relationships. And I wanted to also take advantage of that possibility. So I did do about 8 trips to Europe within the last year or so. to Europe, Turkey, and in Europe I went to London, Brussels, Paris, Geneva, and in Turkey to Istanbul and Izmir and Ankara. And I cultivated these relationships so as to get commitments from foreign investors. And I was able to get commitments. And in fact, I'm going back again this Saturday to Europe to further nurture those relationships. But what we also found at the conclusion of a road trip we did, a road show, which started in Brussels, then Istanbul, and then we did one in Beverly Hills here. And when we did the roadshow in Beverly Hills about the fund, we got a lot of local interest, a very high amount of local interest, which I thought would be very minimal. In fact, it was disproportionate. And so we decided to cultivate that, and now our focus for the last 5-6 months has been almost entirely to enhance the U.S. Investor base, and that means high net worth individuals, family offices, funds of funds, and small pension funds. And we've had very good traction and very strong interest in this business model. A lot of people want to co-invest with us in these properties that are off the market. And so we feel very fortunate that things have developed that way. And often, it's the solution is often in your own backyard, and you forget to look there. Mm-hmm. And I think that that's what we found out. We found out that there was a lot of interest here, but the interest overseas has not diminished. In fact, it's increased in the last 5-6 months as the European economy sizzled, and the interest in the U.S. has increased substantially in light of the political instability close to Europe and in some European countries.
And are you working with a placement agent on the fund, or are you doing what you've been doing and just meeting with people and kind of doing it word of mouth?
It's entirely ourselves, word of mouth. We have and are talking with placement agents, but have not made the decision to pull that trigger. Mm-hmm. And all of the high net worth individuals come from my relationships here in the larger Los Angeles area with my high net worth clients that I've had through the Sanli, Pasteur & Hill firm, and friends, and that have successful businesses and have had successful careers. And the funds and the family offices are through introductions and through my partner John Hartman's relationships. John Hartman is our managing director, and he has over 25 years of experience in real estate and managing funds, raising funds, and running real estate companies. So John brings a substantial amount of value into the process. And so we've kind of been operating on a cost-conscious shoestring and bringing in the investor money.
Also, as a new player, how are you getting potential investors comfortable with your strategy as a first-time fund manager?
Well, I think that the first thing that makes them very comfortable is that most of them have known me and John and other shareholders in my team for a very long time, and it's typically at least 10 years or more.
So it's a very established relationship.
Yes, very established relationships, especially in the Los Angeles area where Sanli, Pasteur & Hill has operated for over 20 years now. So that's one thing. Second thing is that our deal flow is proprietary, unique, and it's very easy to recognize. Mm-hmm. 3 is that the business model is very unique, and it's a very nice story. And it's a story that's compelling because in this environment where value is the most elusive concept, we're taking the dialogue away from value. We're focusing on the capital need of the operating entity inside the walls. And that makes this a very interesting product with a very low downside risk and substantial benefits upside. Now, I'm not talking about huge benefits. Nobody's going to make 8 or 9 times their money here in 2 years. Those days, that's not what our business model is. Our business model is a core, conservative investment diligence process that capitalizes on the resources and skills of Sanli, Pasteur & Hill in underwriting these businesses and having accumulated substantial goodwill and relationships and proprietary information, and be able to then capitalize that and turn that into what I call reasonable conservative business model to generate core investment type returns for our investors.
What, if anything, has surprised you about this process?
Well, I think that what surprised me is that how much I have right under my nose in my own backyard, that how much there is right here within reach, and that I travel the world and put my family, my kids, my wife through such a travel schedule myself, being away all the time, and but I don't regret it at all. But I think that what surprised me is how much interest there is locally in the product, how much interest there is from high net worth individuals, family offices, and
Mhm.
fund of funds and small pension funds that really are looking to place their money intelligently with a sophisticated operator that has a sound and unique story. That's what surprised me.
And as you grow the business, where do you see the fund 1 year from today, and where do you see the fund 5 years from today?
Well, I think that 1 year from today or 18 months from today, I see us having closed the 10 deals that we hope to close, about 10 million each or so, maybe 12 deals in the 8 to 12 million dollars each category. So I definitely see us there and having started to pay dividends to all our investors. And I see us in a year, 2, 3 to start Fund 2 so that we can continue providing expansion capital for some of those companies that we did the deals with, but also for other Sanli Pasteur and Hill clients that we haven't been able to close a deal with this time because they were part of the candidates we were looking at, but selected the A-plus ones. Now we've got the deals that we could do maybe with the A-minus ones, the A and A-minus ones at different pricing, and also expansion deals with the portfolio ones in Fund 1. So Fund 2 would be much bigger in size, perhaps have more of an institutional funding, more of an institutional component in its funding. And that Fund 2 then would focus on additional, maybe 30 deals, and also expansion deals on our portfolio in Fund 1. And on the heels of that, create additional funds. So in 5 to 10 years, I would like us to be a sizable fund management company dealing with unique business models and proprietary deal flow that is coming to us through Sanli, Pasteur, and Hill, but through the accounting firms involved in every one of the transactions and the law firms, because they're going to see, hey, we have some clients that could benefit from this. We have a client here that's doing $50 million in sales, and they own 2 buildings, and I can't get them a $5 million credit line.
Mm-hmm.
This is exactly who I'm looking for. They own their buildings, and they can't get a loan for the life of them.
It seems like there's quite a big base of companies to draw from on that, especially in these times. So
Exactly, especially in these times, and as long as they never thought about selling their building.
I look forward to just working with you over the next couple of years and just talking to you as you guys expand.
It will be my pleasure. Thank you. I really appreciate this.
That's all the time we have for today. Thank you for being here, Nevin.
Thank you. It's my pleasure.
And I'm Samantha Rowan, and this is ReFi Radio.